Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, 12/27. Last Friday video of the year. Went like that. Couple of quick things. Remember, a week like this can be, misleading one way or another in terms of portfolio action, in terms of price action. Volume can thin out a little bit, but we are in the midst of what traditionally is known as the Santa Claus rally. That's the last 5 trading days of the year and the first 2. It's a 7-day period. People like to watch that as a precursor for moves into Q1. It's been a little less of a predictor over the last 7-8 years, but something fun to watch anyway. We're about break even, by the way, this year. What are we looking at? A couple of extremes. You've heard me mention that throughout the 5, 6, 7 years you've joined us on these videos. We like to look for extremes to see if that may be an opportunity for a trade. Doesn't mean we'll do it today or next week, but what kinds of extremes are we looking at today? Well, in small cap growth and value, no extreme there. They're both down between 5 and 6% month to date being December. Mid cap, same scenario, 5.5% drawdown month to date. That, by the way, that's a significant drawdown when you look at the indices, which are pretty tight, right? S&P just down 1% month to date. Qs, or the NASDAQ 100, actually up month to date. Where are we seeing an extreme? Large cap growth, pure growth, up over 3% month to date. Large cap value, so we pull the value names out of the S&P, down about 5.5% month to date. There's an extreme. Growth up 3 and change, value down 5. 8% dispersion between those two baskets in less than a 30-day period is an extreme. What it has led to in past is a reversion to the mean. It doesn't mean it's a 30-day or 60-day reversion to the mean, but when we look out 6 and 12 months, the style, be it growth or value, that has underperformed to that significant spread has shown a tendency to rebound strongly. So what areas do we want to watch to see if that rebound starts to occur in Q1 or even Q2? Well, one of the largest sectors in the economy and in the S&P 500, that's healthcare. It's been dismal, brutal. We have been underweighted, so we've been somewhat fortunate in that area, but you can't help but pick up some of these value areas if you own index type ETFs. So is there something within biotech, medical devices, healthcare insurance companies that is starting to trigger extreme pessimism? We'll take a look. We're going to watch some of the options activity in there. We're going to watch some of the new highs versus new lows. We're going to watch some of those breadth indicators. We can also bring that up over to energy. We can also take a peek at REITs or real estate in that area, seeing extreme dispersion of those underperforming sectors versus the outperforming sectors. That does not mean you automatically just flow into the underperformers, but it is worth watching. So as we take a look at tech and consumer discretionary and some of the solid names within growth and some of the solid sectors within growth, we respect that strength, want to let that strength run, but have to pay attention when we get to an extreme in a divergence scenario. So just something to think about. We'll follow that up next week with some charts and some graphs, which we like to do at extremes. And I think those have been helpful this year. If you recall, we pointed out that extreme back in the spring when the S&P versus the value end or the equal weighted end of the S&P had stretched to over 15% performance dispersion. We leaned into that a little bit. Let's see if we lean into any of the negative performers over the next 30, 60 days. We'll certainly let you know. Moose is next. John, take it away.
Thanks, Matt. We are filming on Thursday, December 26th. This week in the bond market, a little bit rise in yields. 10-year bond as we sit here today is at a 462, up 10 basis points on the week. Muni bond yields unchanged. The 10-year AAA rate is a 308, unchanged because there's no deals this week. And a typical holiday week. What we do have is some economic statistics. We saw initial jobless claims today be a little lower than expected. We saw continuing claims a little higher than expected. Continuing claims are now at the highest they've been in 3 years. There's some other statistics out there that also give us some pause to think that the economy at the margin may be slowing down. Here's one: the Philadelphia Fed non-manufacturing index. It's an index which basically takes the middle Atlantic area and measures people's sentiment in terms of sales, orders, business conditions, etc. And it takes the positive numbers that are things are improving away from the negative numbers that people are saying are declining conditions. And it subtracts the two. As you can see from this graph, you have been in this negative territory for a year. So it is a little troublesome when you start to see bond yields as high as they are, even though some of the business conditions out there are a little less, as in this case. We will know more next week when we get the first jobs number. That will be in the first Friday of January. Certainly that will start to set the tone because in our view, bond yields, which have gone from a 370 in the middle of September on the 10-year bond to a 462 today, so up over 90 basis points in essentially 3 months and a change. And all of it starting when the Fed cut the Fed funds target rate 50 basis points back in September. So it is rare, if never heard of, that you see a Fed start a rate cutting cycle and longer term rates go higher. And that is what the expectations of a Trump presidency have done to the bond market. We have January 20th inauguration. Logic would tell you that the rise in rates we've already seen has started to chip away a little bit at the economy through some higher interest rates, not only affecting credit cards, mortgages, etc. So we'll be watching this as we get into the new year. We hope everybody has a great new year, and we will see you in 2025.
Thank you, John. Great information. I hope everybody enjoys the rest of the holidays. Have a peaceful weekend, and we will speak to you next year.